Hello all, welcome to a brand new video. This video just might change your perspective on how you view the markets, how you read the charts forever. I am going to show you how liquidity works within the markets, and it is going to be a game changer in your trading career. So just stick along, watch the video. I promise you, if you truly understand this video, if you truly understand what I'm trying to tell you, it will definitely shift a perspective within you. If you already know it, good enough, well, that's great for you. But then for those who doesn't know, it is going to be a very important lesson for your trading career, and it might just help you very, very, very much, because it did for me, and that's why I'm sharing it to you. So stick along with the video and see if it's useful for you. For those who are new to my channel, hello, my name is Ashish, and I am an equity and a forex trader. I've been trading since 2020, uh, and welcome to AMFX. So let's head to the video. So let's get to it. What is liquidity? I am not going to give you the textbook definition on what liquidity is. Whenever I mean liquidity, whenever I say liquidity, what I mean by that is that liquidity is accumulation of significant amount of orders at particular points within the price of an instrument. Meaning, the market is filled with liquidity. Every swing highs and swing lows that you'll be seeing within the market is one form of liquidity or the other. All these liquidities are distinguished based off on their strengths, because some liquidities will have 100,000 orders, for instance, but others will have 500,000 orders. Okay, and based on that, they will be distinguished on which one is stronger and which one is less stronger. There's nothing like useless liquidities or anything. It's just one is much stronger than the other. Okay, and we are going to focus on liquidity for the reason that, what do you think, how do you think big players are determining the direction of the market? Big players aren't like retailers. For retailers, the problem is that whenever uh, we don't we don't find a problem within the market, because wherever we put in an order, it gets filled. It's very easy for us to take a position, even if it's a big retailer. Even if you have like $10 million and you're trying to trade in forex or equity or wherever it is, unless you're trading in penny stocks, and even in some of the penny stocks, you'll be able to get your order filled completely if you put in, right? But that's not the case for institutions. Institutions are gonna pump in tens and hundreds of millions of dollars into the market all at once, and they want to do that to capture certain moves. And they can't do that like retailers. They can't put all of those orders in one single instance. It's not gonna work that way for them. They have to put it in small tranches. They have to do accumulation. That's why we learn these concepts called accumulation, manipulation, and distribution. They accumulate all the quantity that they want within a significant range of price, within a specific range of price, so that when the time comes, they can just fill in the remaining order and let the market move. And we are trying, all retailers are trying to do is they're trying to get into that move, right? And that's the reason we are focusing on liquidity, because institutions are going to look into these points where there are significant amount of orders, so that they have enough liquidity to move the markets or just to get their orders filled. And that's the zone where we have to look deeper into, and this is what is going to determine the direction of the market, because institutions want to get their orders filled from one liquidity to another. They are just profiting off from moving from one liquidity to another. There can be some news impacts, but news doesn't happen every day. And even if there's an impact, even if something huge comes up and if it creates a significant direction within the market, it's going to take a while for that to play. And as you understand this concept deeper and deeper, you are going to understand that the market is going from one liquidity to another. If it's bullish or bearish or consolidating, it doesn't matter. All it's doing is that. Okay, that is what the market is eventually trying to do, and we will get deeper into that. And why is it going to be a game changer? It's going to be a game changer because you will be planning your trades at a point where the institutions are planning the trades. So what the major problem retailer faces is that they are looking at points within the price where there is least interest. There could be interest, but it's not significant interest, that there isn't much volume at that specific point for them to create a valid setup. For creating a valid setup, it requires a point of interest, right? We all try to find that point of interest at some point in the within the price, but sometimes we get lost. Sometimes we get completely paralyzed from looking into too many things, that we start looking at anything as a setup. And if we focus on top notch liquidities, I mean, like the high pool liquidities, we are not going to get into that mess. We can just focus on these high pool liquidities, which happens once a while. When I mean once a while, probably like 2 3 times in a week, now maybe less. And just look for entry models within that. Entry models is a whole different topic. We'll get to a lot more topics from here. This is just the bare bone basics. I use this as my foundation to understand the markets. This is the understanding with which I operate in the markets. I don't have any other understanding. I'm not trying to create a bias that I'm bearish or bullish. I just look at the market structure. It gives me a bias, but then the direction for short term isn't determined by my long term bias. My risk management is determined by my long term bias, but my trade setups doesn't have to be. All I'm trying to do is stay in line with liquidity. I'm moving from one liquidity to another, and I'm going in and out of it. I'm not trying to ride a huge wave. Okay, 1:2 is more than good enough for us. So let's get to a simple visual example on how liquidity works. Let me just get this here. Okay, fine. Okay, so consider this as, a pool of liquidity. Each one has its own strength. The darker ones have more orders in them. The lighter ones have a little less orders in them. These ones have a little more less orders in them. But all of these have its own strength. All of these can attract the price to them. But let's try to predict how the price might move. Let's say the price is starting from here. This is the starting point of the price. If this is the price, where do you think the price is going to move? The price is going to move to the significantly stronger liquidity, because this is the one that is very much closer to me. And the price is going to go to this liquidity and mitigate it completely before it moves to the next closest one. And once I mitigate, even though this is stronger, I went for this, right? The price went for this because this was closer to me. It's easier for me to mitigate this, get more orders in, and then go for the next one, because I'll have enough fuel in my tank to go for this one. So right now I took this out. Right now I'm going for the next big one. Yes, I took that out. Which is the next closer one to me? This one. It's the closest one. Even though this one and this one is stronger, I'm going to mitigate this one and then go for the next closest and the strongest one. And then I'm just going to sweep all these out. There will be times where the market is not going to take any liquidity that is in the vicinity at all. And probably it's not going to be taken for a long time. Just ignore those. Just for mark, your job is to mark all these liquidity levels and focus on your mission. Okay, which is when the price comes to these liquidity levels, it's your duty to use your entry models and look for entries. If it doesn't happen, it doesn't happen. Okay, it's not like there is one liquidity and it's never going to come back. The market is going to keep creating these liquidities, because it's absolutely essential for the markets to keep creating these liquidities. It's basically called liquidity engineering. You engineer these kind of liquidities. For instance, you should be aware of this retailer pattern. This is like, I don't know what it's called. I think it's called a wedge or something, right? So when the price breaks out, what is a retailer going to do? They're going to either buy here or they're going to wait for a retracement to buy here. But what does this look like? It looked like equal highs, which means there is a huge pool of liquidity here. So this move is probably a manipulation by the institutions to just push the price down and take the remaining orders that is underneath, which is their stop losses. Okay. And that's why a lot of retailer concepts fail, because it doesn't work. It's bullshit. Now, what are the types of liquidity? There are three kinds of liquidity. There are even more, but what I focus on majorly is fair value gaps, rejections. Rejections basically means huge big candles. Uh, if a candle, uh, if a candle has a huge wick, it means that the opposite party gave good kind of pressure to the one that was winning at the last minute, which means that there is a good rejection from that point of time. Fair value gaps, most of you at least would have heard about it. It basically means imbalances within the market when price goes erratic within the chart. And order blocks. Order blocks are something I don't use often. I just keep a look at it. But if you're looking into the liquidity concepts, it's always, order blocks make logical sense to have a look at it, because order block is the previous candle before the momentum stepped in, before there were huge green or red candles, the candle right before that. um, the basic logic is that all the institutions press their buy button or sell button at that during that candle. They would have been accumulating even before, but the volume is higher in that candle, and that's why order block is also a significant liquidity point. But we will be covering very less about order blocks. These two are the main ones I look into, and we will be going much deeper into these concepts, because I am not going to information overload in just one video. It doesn't work. If I give all the concepts out in just one video, you are not going to learn anything out of it. It's better that you learn what liquidity is. You try to see the market from that perspective, and then try to create your own view or patterns out of that, and then you can get into the concepts. Okay, if you already know the concepts, well and good, but if you don't, we will be covering that as the days go by. So just stick by it. Okay, just try this out. It's going to work like a charm. So let's backtest this in gold. So this is gold chart, 4 hours. I have already plotted all of it, so that will be easier for us to just stream through. This is in a bullish trend, right? Easy. Just market structure shows it. This is a fair value gap. I've drawn the fair value gap. Okay. Market kept going up. This is a peak rejection. These two have been formed as liquidity on the downside. So market exhausted all the liquidity over here. It came back down, took out these liquidity, and started shooting up again. The market kept going up. The market kept going up, creating even more fair value gaps on the way. This is another fair value gap. This is another fair value gap. This is a rejection. I didn't mark that, but that is a rejection. And this is another fair value gap. And market again got exhausted from pushing upside. It reversed on the ass. It just came back and created another bearish fair value gap here on the way. It didn't sustain this fair value gap. It failed this fair value gap, completely broke through. I marked this to show that nothing is 100% within the markets. Okay, if you think something is going to work 100% of the time, you are soon gonna be kicked out. Okay, that's not how it works. We are not going to enter into a trade as soon as it touches these value points. It doesn't work that way. It's going to a bunch of times it's going to fail. Okay, you might even draw some fair value gaps and rejections wrong, and that is going to make you pay. So you need proper entry models at play to actually capitalize on these. What I'm trying to prove from this video is that this concept is valid. It works most of the time, and with proper entry models and rules in place, you will be able to capitalize out of it efficiently, basically. Okay, it created more peak rejections here, and it took out this fair value gap too. Even though it reversed, it's not valid. The minute a candle closes below this gap, it's it's not valid anymore. Okay, so even this one failed. For some reason, it went back to this liquidity here, and again it came back to, there is a fair value gap here. When it went up, it created this fair value gap. It tried to sustain, but it didn't sustain. It again failed. It came down, took out this rejection, finally took the Hail Mary fair value gap. Below this, it's too low, so it reversed from here. This was a proper reversal from here. It reversed, kept going up. There is a rejection here, kept going up. There is a fair value gap here that created on the way. It came back, took this rejection and took this fair value gap and reversed from here. Again kept going up, created a fair value gap, sustained. There is a peak rejection that it created here too when it came down. So finally it went up, took this fair value gap, and it did break the market structure. So this was a valid fair value gap. It's mitigated as of now. But then it finally broke that fair value gap. What did it create on the way down? It created a bearish fair value gap right now. So it means that it's going towards the, and again, it's showing a bearish sign within gold. So my estimate is that it's going to go towards the next liquidity point, which is this rejection. Okay, and I don't know from there where it's going to go. But the concept is sound. Now, from this, probably you might be able to understand that the market is moving from one point of liquidity to another. Sometimes it's going to fail, but most of the times it's going to work. And with proper entry models in place, you can capitalize on these. What I have found is that it works best in gold and Euro USD. It does work pretty well in Indian markets too. In Nifty and Bank Nifty, it works like a charm. But it's going to take a little bit more work in Nifty and Bank Nifty now, because there are a lot more gaps within the market, since each day is each day there's a closing time and there's pre-market and all of that. So the chart is a little erratic in that. But then in Forex, the gold and Euro USD is a go-to for this particular concept. It works in everything, but I have worked extensively in Euro and gold, so I can confidently say that it pretty much works well. Since we are already in gold, let's see what's kind of cooking up. So this is a bearish fair value gap. It's taking good rejection from there, created a bearish engulfing within 4 hours. If I go down, there is a fair value gap here. Markets are fractal in nature, which means that if it works in one time frame, it's gonna work pretty much in every time frame. So understand that. Okay, it's not like if one time frame is stronger than the other. Yeah, obviously the least ones, the 1 minute, 2 minute, 3 minutes, all these are very erratic because it requires very less money to manipulate in that time frame. So institutions keep doing that. But then in a little bit even higher time frame, which is like 15 minutes, it's kind of harder to do it. So I would say try to stick to 15 minutes and above, not less. And in this scenario, it's going towards that fair value gap, and probably it's gonna reverse from this point to the next rejection. Now, but usually I don't hold that much. I just take a 1:2 or 1:3 and just get out. So that is my plan. Okay, I hope you guys understood what liquidity is and why it should be in your system. Okay, why it should be an integral part in your system and why it is in mine. Okay, I hope this video was useful for you guys. We have reached the end of the video. I hope that was immensely useful for you. If it is useful, please go back test it and simulate the concept in your mind and come back for the next one, because there is going to be a playlist which is going to contain all the trading strategies and secrets I know. And if you thoroughly go through all of that, you might just find something in it that is going to change your life. I can promise you that. At least for one person who's seeing this, it's going to do that. Okay. So if you love the video, if you want to stick along the journey, just give a thumbs up, just hit the subscribe button and stick along. All right. Thank you so much for watching the video. Bye bye.